Hello, and welcome back to our webcast series on the equity method exposure draft. I'm Filippo Poli, technical staff at IASB, and today I'm joined by my colleague Mustafa Muit.
Hello everyone. In the previous webcast, we introduced the project. In this webcast, we are diving deeper into the main proposals in the exposure draft.
IAS 28 requires an investor to recognize the investment initially at cost. One of the application questions in the project scope asks what should be included in the cost of the investments. What is the IASB proposed answer to the application question?
The IASB is proposing an investor measure the initial cost of the associates at the fair value of consideration transferred, including the fair value of any previously held investments. For example, say that an investor holds 5% of an entity. Later, the investor purchases an additional 20% and concludes that it has now obtained significant influence. The IASB is proposing that the cost of the associate includes the fair value of the initial 5% interest at the date the investor obtains significant influence. This should be the carrying amount of the previously held investments, which is the financial instruments carried out at fair value applying IFRS 9. Filippo, can you tell our viewers what else the IASB proposed on initial recognition?
Yes, the purchase agreement may include contingent consideration as a part of the arrangement. In that case, the investor would add the fair value of the contingent consideration to the consideration transferred. Those proposals were developed from the requirements in IFRS 3 for business combinations. The investor would also include in the carrying amount of the investment the deferred tax effects related to the share of the fair value of the associate's net assets. The IASB has not changed the requirement to classify the investment as a non-current asset.
Thanks, Filippo. Moving on, the next question is about the IASB's proposals when the investor purchases an additional ownership interest or disposes an interest in the associate while retaining significant influence.
Yes, retaining significant influence means that the investor continues applying the equity method. IAS 28 explains what to do when the investor loses significant influence but does not have a requirement for that situation. To answer the question, the IASB is proposing that the investor measure the additional share of the associate net asset at the fair value at the date of purchase. The difference between the consideration transferred and the additional share in the associate net asset is either recognized as goodwill, which is included in the carrying amount of the investment, or as a gain from a bargain purchase in profit or loss. The whole investment is therefore an accumulation of purchases. Therefore, the investor does not remeasure the previously held interest. Now, Mustafa, can you let our viewers know about IASB's proposal on partial disposals?
Of course, I think it's best to explain the IASB's proposal on this matter by way of an example. So, if an investor holds 30% and disposes of 10%, it derecognizes 1/3 of the carrying amount of its investment and recognizes the difference between that amount and the consideration received as a gain or loss in profit or loss. The IASB concluded that after initial recognition, the investment is a single unit of account. Therefore, when disposing of an interest, the investor is not required to identify a specific layer that is being disposed of.
Okay. One question that has been outstanding for some time is when other events or transactions change the investor's ownership interest. For example, an associate issues new shares to another shareholder. In this case, the investor ownership interest would decrease. This decrease is often called a dilution.
The IASB is proposing the investor accounts for these changes as if purchasing or disposing of an ownership interest. Therefore, dilution gain or losses would be recognized in the investor's profit or loss.
Okay, I think that summarizes the IASB's proposals on these application questions. So let's move on and discuss some of the application questions on recognizing the investor's share in the associate profit or loss. IAS 28 requires an investor to stop recognizing his share of the associate losses when the carrying amount of the investment has been reduced to nil, unless the investor has incurred an obligation. And there were two questions about that, which are shown on the slide.
IAS 28 requires an investor to recognize separately its share of profit or loss and its share of other comprehensive income. If both of them are losses and in total exceeds the carrying amount, the investor cannot recognize both because the investment would become negative in this situation. So the IASB is proposing an investor recognize first its share of profit or loss.
But what if when the investment is already being reduced to nil, one of the shares of profit or loss or OCI is a profit and the other one is a loss?
In this situation, the IASB is proposing an investor continue recognizing the two shares separately for the same amount. For example, if the investor has already reduced its investments to nil and its share of profit or loss is a loss of 200 and its share of other comprehensive income is a profit of 50, the investor would recognize a loss of 50 in profit or loss and a profit of 50 in other comprehensive income. Recognizing the two shares separately instead of showing no impact would improve information to users.
One question that the IASB has investigated in the past was how to recognize gains or losses when a parent entity sells a subsidiary to an associate. Can you explain what the issue was and what the IASB is proposing?
This is a significant change to the existing requirements. So applying IAS 28 today, an investor restricts the portion of gain or losses on transaction with associates. This restricted gain is recognized later when the transfer assets is either sold to a third party or depreciated. However, IFRS 10 requires an entity to recognize in full the gain or loss when a parent loses control of a subsidiary. The IASB had issued amendments to IFRS 10 and IAS 28 in 2014 to address this inconsistency, but deferred their effective date. Filippo, given what I have just mentioned, could you walk us through the IASB proposals on this issue?
Yeah, sure. The IASB is now proposing that an investor recognize in full all gains and losses from all transactions with his associates. And to help users understand the financial effect of those transactions, the IASB is proposing that an investor discloses gains or losses from downstream transactions. The IASB decided that this approach is simple for preparers to apply and for users to understand, and does not require differentiating between different types of transactions.
Thanks, Filippo. One question I have is how the proposals affect the equity method when it's used in separate financial statements.
Yes, the IASB has decided that when an entity applies the equity method to any investment in the separate financial statements, it should also apply all the proposals in the exposure draft. The IASB acknowledged that the proposal to recognize in full gains or losses on transactions with subsidiaries accounted for under the equity method in separate financial statements will create a difference between how intragroup gains or losses are recognized in separate and consolidated financial statements. But Mustafa, can you let our viewers know what the alternative would have been?
The alternative would have been to have a second version of the equity method for investments in subsidiaries in separate financial statements, which would have added complexity to IFRS accounting standards.
And with that, we conclude the second part of our three-part webcast series on the equity method exposure draft. In this session, we have covered the main proposals, and we hope you found this information useful. We encourage you to join us for our third and final webcast, where we'll discuss the remaining proposals.
To find out more about the project and submit comments on our consultation, please visit the IFRS Foundation's webpage. Remember that the comment period is open until the 20th of January 2025. We look forward to seeing you in our final webcast. Thank you.